The broadcast is now starting. All attendees are in listen-only mode.
Good evening. Good evening, everybody. Good evening. Can you guys hear me in the back okay? Perfect. Well, welcome to Ironwood Wealth Management's 2018 tax seminar. My name is Craig Moore. I'm a member of the Financial Planning Division, and we're privileged to be able to host this event for you. As many of you know, as clients, one of our primary goals as a firm is education of our clients. And so, to that point, this is why we enjoy bringing to you hot button topics in our society that we find relevant to our clients in the financial realm of their lives. Before we get started today, we have a few housekeeping chores to get done. There is a sign-up sheet or a sign-in sheet somewhere around here that, per compliance, we need everyone to sign in. Don't worry, we're not going to spam you or anything like that, but again, for compliance, we do need you to sign that form. Also, in front of you, you'll see a feedback form and surveys. We would greatly appreciate your feedback at the end of the night. We take it very seriously. We always want to know how we can improve and do better for you next time. Other things that we need to address, for those of you who don't know, we are also streaming this via webinar, so we have about 50 to 60 people tuning in via that method as well. So for their convenience throughout the presentation, if we can hold the background noise to a minimum so they can hear adequately, we greatly appreciate that. And for those on the webinar, you can click the PDF files located in the GoToMeeting, and you'll see Margaret's bio as well as the tax handouts that everyone here has. And welcome to you on the webinar as well. On the webinar, on the lower box, you can type in questions, and we will try to address those in real time. And with that said, I would like to introduce our speaker for the evening. Margaret is a great asset, and I know a lot of you know her well. She's a great asset to our firm. She allows us to pick her brain constantly and get updates and really the inner workings of tax preparation and all of that. You have her bio in front of you, but I like to highlight a few things. She has a degree in mathematics and computer science from York University. And in her first career, she worked in computer applications, system design, and software development. That brought her to Phoenix ultimately, where she earned a master's in business administration. And she got a this is a hard word, baccalaureate certificate in accounting, ultimately opening up her own firm in 1999. Quickly grew to over 400 households. Now she's semi-retired, but is still able to assist a lucky few with their taxes. And again, as I said, a great asset to Ironwood Wealth Management. So without further ado, Margaret Stallworthy.
I'm really happy to see all of you here this evening. I see some new faces, a lot of familiar faces. You have no idea how much I was hoping to be fully retired before this happened. Our government being what they are, they cranked this out, effective dated December 22nd, 2017, the sort of thing that people in my business lovingly refer to as our Christmas turkey. And if you really want to feel sorry for people, feel sorry for the folks who write the tax software and have to update the manuals, because around about now, all of us users start complaining when those things aren't up to date, but that means they had work through Christmas and New Year's. So if there's anybody out there that needs our sympathy, it's them. You have in front of you a pretty cut down handout. We're only going to address individual tax changes tonight. I was in a seminar on Friday. This is the handout booklet from the 4-hour seminar, which only addressed individual changes. We boiled that down to about 30 slides for you guys tonight. If I tried to touch on business other than just very, very briefly, we could be here for a week. And I haven't taken that seminar yet, so I don't know what I'm talking about anyway. Many of these changes that you're going to see tonight on the individual side are scheduled to expire again at the end of 2025. That means we've got 8 years to live with this and its technical corrections and whatever other minor changes may come along. And then if Congress doesn't do anything, it'll all revert right back to what it was at the end of 2017. That's not going to happen. There's no way that would happen. So we can plan on there being at least one more tax law between now and then. But when it'll come and what it'll look like, who knows? So if you don't like what's in this one, let your congressperson know. Okay, and the other thing I'd like to mention, we're really going to try to stick to just general information tonight. If you have a very specific question that's pertinent to your own particular tax situation, I would ask that you not raise it tonight. There's a couple reasons for that. One is you probably don't want to discuss your taxes in a room full of 60 people with 40 others on the web. And it's also probably something that needs a little more research into your situation with looking at your specifics before it can really be answered. Anyway, but general questions are welcome. We'll start out letting you ask them as we go along. If I get the sense that this presentation is slowing down too much and we're never going to get out of here, I will ask you to please hold them until the end. And anything we don't get to address tonight, if you want to submit them to Ironwood, I will put together a response packet and send them all out to you at a later date. Okay? All right. So the first thing that you have in there that you might want to take a look at is you've got two tables, one above the other, that are headed comparing tax brackets. And the reason I've given you these is I just want you, whoops, what happened? Seeing kicked into the webinar.
Sorry.
My thing went away. I wanted you to have them, but I mostly wanted to just so we could highlight what kind of really happened here. You'll notice if you count that we still have 7 tax brackets. There was a lot of noise when this was going through Congress about how we were going to simplify this. We were going to get down to 3 tax brackets. Everybody was going to be able to file their taxes on a postcard. It just kept going and going and going, and revenue things came in, and pretty soon everybody realized that if they didn't do something more than that, they were never going to be able to raise enough money. So we're back to 7. They're all a little lower than they were. I'm sorry, the very bottom one seems to be cut off on this screen. I think it's on your printout, the 37% bracket. They're all a little lower than they are. Most of the cutoffs for the individual brackets have been widened out. Generally speaking, they make sense until you get down to the 35% tax bracket. And then the thing we've known and hated for years as the marriage penalty is back with us in spades. Because you'll notice that in the single column and in the head of household column, the end of that 35% bracket is at $500,000. You would think logically that married filing joint would be double that and that married filing separate would be kind of the same as single. Wrong. Married filing joint breaks off at 600,000 and then after that bumps up to 37%. So anybody in a higher income tax bracket who's married is going to be paying more taxes than they would if they were 2 single individuals. I'm not advocating divorce, I'm simply pointing out this may be an area where we may see some technical corrections if enough people pound on Congress about it. Okay. Next thing, there's a few myths kind of floating around, some stuff I want to clear up. First of all, there is absolutely nothing in this tax law that in any way, shape, or form is going to affect your 2017 tax returns that we are just now getting ready to file, with one minor exception. You remember that for many years, we got medical expense deductions to the extent that they exceeded 7.5% of income. Then a few years ago, for younger folks, that went up to 10%. Those of us who are a little older than that still had 7.5%. Until this year, it was supposed to be 10% for everybody. Somewhere in one of the trade-offs for something else in this tax code, we got 7.5% back for 2 years, for 2017 and 2018. And then when we hit 2019, it's going to go back up to the 10% number. So it's not a real big change, and it is the only thing that's going to affect your 2017 return as far as actual processing is concerned. There are no changes to the amounts that you can put into your 401ks, your IRAs, your other tax-deferred savings accounts, other than the ones that were already scheduled to allow for inflation adjustments and so on. And while I'm on that subject, just a word of caution, somewhere buried in this mess, there's a change in how the IRS is going to compute inflation adjustments. They've gone from something called the Consumer Price Index, a CPI, to something called a chained CPI. That has, I'm not an economist, maybe Sean can explain it, but it has something to do with the way that changes in one thing affect changes in another, rather than just looking at the changes themselves across the board. And it tends to slow down the rate of inflation. What that means is inflation adjusted numbers will grow more slowly. IRS put out a set of inflation adjusted numbers for 2018. They put most of them out in October. That was before this bill was finalized. They said last week they're going to go back and recompute all that stuff. So anything you see anywhere that's a 2018 inflation adjusted number, if it's not after IRS announces the new numbers, don't count on it. Go back and recheck the source, because it might have changed. And there's going to be numbers everywhere that that's going to affect. When they'll get it out, I have no idea. Maybe they'll decide not to do it after all. Just don't know. I can't find any reference to it on their website, so maybe they decided not to. But they have not made an official announcement that they decided not to. So, you know, we'll see. Another thing everybody was worried about, those of you who are active teachers, you still have your $250 above the line per teacher deduction for classroom expenses. I know it's not much, but it's something, and that was one of the things they talked about taking away. And in the last minute conference committee report, they decided not to take it away. So we still have that. We've got minor changes in charitable contributions. Now, this interplays with standard deductions, so we'll get to that later. But as far as the actual law on charitable contributions is concerned, it did not change, except that they increased the maximums that you could do in terms of percentage of your income from 50% to 60%, which for very generous people, or people who have not that much taxable income, but lots of money to give away because they've structured their lives to have mostly non-taxable income, that's going to be helpful. But whether or not you're actually going to use them is going to depend on what your itemized deductions look like. So we'll come back and revisit that. Non-cash limits didn't change. And I'm sorry to tell you all, you wonderful ASU athletic supporters, but you're not going to get a deduction for the part of your season ticket fee that used to be deductible. That has been eliminated. Yeah, I guess you can still make donations directly to the ASU athletic program. You just can't do it in conjunction with buying your season tickets. And there's been no change on the business about gambling losses being deductible to the extent of your winnings if you're itemizing. Okay. Nothing really changed with long-term capital gains and qualified dividends. And I say that because those brackets, the 0%, the 15%, the 20%, and the tack-ons for the net investment income tax, those are still there, and they're still there at those percentages. Because those percentages don't tie to your tax bracket percentages anymore, there's a whole separate set of tables for people like me to try to figure out how much tax you're going to pay on your gains. Thank goodness for computer software. We'd never get there from here. They have decoupled them. They're completely different tables. They will change at their own rate, unrelated to anything else that's going on in the tax code. And there has been no change in the qualification for the exclusion of gain on your primary residence. This one was close. We were right down to the wire with something in the bill that planned on extending that, so that instead of having to own it for 5 years and live in it for 3 or 2 rather, to exclude the gain. They were going to push that out to owning it for 7 and living in it for 5. And they did not change that. They pulled that change at the very last minute. Still have the old rules. That's going to make some people happy, especially people that have houses under contract this month. Okay, now here's where we got some changes. They're not as bad as we thought they were going to be, but they're there. First of all, the deduction for state and local taxes. That includes your state income tax, your real estate taxes on personal use property. Doesn't apply to rentals, but personal use property and the part of your car registration fees that are considered personal property tax, or if you happen to live in a manufactured home, those are treated as personal property, and they have personal property tax as well. The combined total of all of those things is going to be capped at $10,000. So for some people, that's going to make a difference. Some people have real estate taxes that are fairly high. If you make a significant amount of money, your Arizona income taxes are probably getting up there. I'm not sure how or if they're going to prorate this, whether they'll give it a priority or whether they'll say we're just going to, across the board, if you're at 12,000, we're going to take 5/6 of each deduction, or how they're going to do that, I don't know. But there is going to be a cap. Now, like I said, remember, this does not apply to taxes that are levied on properties that are used for business purposes. So that would mean business buildings, rental properties, that kind of thing. They still have their own rules and their taxes will be fully deductible. This only applies to personal use. But it applies to all properties you have for personal use. It's not capped at 2. Some people think it is. Some people think it's primary and secondary home. No. If you have a primary home and you have a property up in Payson and you got a couple of pieces of land scattered around, all of that stuff is still going to be deductible, but it's going to fall under this $10,000 cap. Okay? Mortgage interest. Now, here's where we really get confusing. Once again, we're talking about personal use property. This time we are talking about, on the itemized deduction schedule, no more than 2 properties. Rental properties get their own, and business properties get their own. But for personal use properties, your mortgage interest is going to be limited. It's going to be limited differently. The current rule, and leading through 2017, is that all acquisition debt, which is debt you incurred to buy, build, or substantially improve the property, was capped for deduction purposes at $1 million. But you also got another $100,000 of home equity debt that could have been used for anything. And that was the limit on the amount you could deduct. For loans that were in place as of December 14th, we're still grandfathered for that $1 million limit until such time as those loans are refinanced. For any loan that was placed after that, so December 15th or later, the cap on the acquisition debt is $750,000. Okay, so that's the first change to keep in mind. The second change to keep in mind is that interest deductions on home equity debt are gone. You don't get them. They're not grandfathered, they are simply gone. Now, somebody asked me today, well, I refinanced a loan in 2017. How does this affect me? And I said, well, we have to go back and look at how much of that loan represents the original acquisition debt from when you bought the property and anything you may have added on to it. Interest on that part will remain deductible. Anything above that that we cannot trace to one of those allowable uses is not going to be deductible. Now, if you think about that, if he bought that property back in 1965 and he's refinanced it a few times, this could be kind of tough. I'm hoping the IRS is going to come up with some sort of reasonable regulations that says you only have to go back, a certain number of years, but they haven't done anything yet. So all we can look at is plain language in the law. The one thing I need you to understand is you may have home equity debt you don't think you do, because when you refinanced your loan, even though you didn't increase the loan balance, Maybe you rolled your appraisal fees and your loan costs into the base of the new loan. Guess what? Those rolled over fees are home equity debt. On the other hand, you may have a loan that your bank says is a home equity loan, a HELOC. But when you took it out, you used it to put a swimming pool in your backyard. That is not home equity debt. That is acquisition debt because it went to substantially improve the property. If you have a home equity loan that you took out and you used the money to invest in something, maybe you put it into a business, maybe you loaned it to somebody they're paying interest on, something you use that can be traced to an investment kind of use, it will remain classified as investment interest, not home equity interest. So just because the bank says it's home equity interest doesn't mean it is. They have a limited number of bits of terminology for this kind of thing. But the tracing is going to be really important. Yes, ma'am?
Are banks gonna make this clear to people?
Kathy just asked if banks were going to make this clear to people. I would say probably not. So if you have your refinancing statements from way back when, hang on to them. If you don't have them, then we're just going to have to do a best and most reasonable guess and hope for the best. Like I said, that's where I'm hoping IRS is going to come down with some kind of logical regulation that says how to do it. Because otherwise, they're never going to be able to audit it, never mind us figuring it out. So we'll see where that goes. Oh, you're all going to hate this. All those lovely miscellaneous itemized deductions that you got if they were more than 2% of your adjusted gross income, your unreimbursed business expenses, investment advisor fees, what you paid to get your taxes done, your safety deposit box rentals, all those things, they're not going to be deductible anymore. There are some ways to get around that, and I'll get to some planning slides in a bit, and we'll see what we can do. But generally speaking, those deductions are just kind of going to go away. Casualty and theft losses. We used to be able to get those if, I don't know, somebody stole our car, or our house burnt down, or something traumatic like that happened. Now they are limited, and you only get them if you happen to live in a presidentially, federally declared disaster area. I am still waiting for the logic by which the California wildfires and the hurricane in Puerto Rico are not federally declared disaster areas, but the ones in Texas are. Do we think maybe it has a little bit to do with the color of the state when they voted? Kind of think maybe. We'll see if we don't get some corrections on this one. I hope we do. You will no longer have exemptions for personal exemptions and exemptions for your dependents. Now, according to the IRS, this is supposed to be covered by the fact that they raised the standard deduction, they changed the tax brackets, they've changed the credits for children and non-child dependents. And in theory, at least, it's supposed to wash out. It doesn't work for everybody. For a lot of people, it may kind of wash, and for some people, it may be helpful. But for now, just keep in mind, there will be no more dependent exemptions. So I won't be pestering you about whether your kid still lives at home, or are you supporting him at college, or what's the status of this kid, because you can't take a deduction for him anyway, so why bother? The standard deduction, now this is where things start to change. I don't have a total handle on these numbers, but just ballpark wise, I can tell you that in 2017, these are in the like 6,300 to 6,400 range for a single, around 12,000 and some change for a married couple. And about the same amount as the single, so a little bit more per head of household. And there's some tax months for people who are blind and disabled or are over the age of 65. Almost all of that is doubled. You'll notice the single has gone up to 12,000, married has gone up to 24,000, 18,000 per head of household. That's why a lot of people are saying, oh, well, we're not going to have charitable deductions anymore. No, you still have them legally in the law. It's just that for some people, they may not come up to enough money to get over the standard deduction. And if the standard deduction is more, we're going to use it. So it's not that those things went away. It's just that they may have become slightly less useful.
So in the standard deduction, for instance, 24K for married and one, in that 24K, everything that we're used to throwing into our deduction is covered in that 24K. Two instances, or one instance especially, gambling losses.
You have to itemize to get those.
Everything has to fold into the 24K?
Yeah, if you decide to use the 24,000 standard deduction, all of the things that you would normally track for itemizing, you no longer have to track. But if they add up to more, you still are going to want to track them because it's standard deduction or itemized, whichever is more. Okay, and on top of that, Arizona's itemized deduction limit is much lower than the federal. And so far, we have not heard from them about what they're going to do about this law. So you may very easily be in a position where you're going to want to itemize for Arizona, even if it doesn't do you any good on the federal. So don't stop tracking that stuff because we may still want it. But yeah, the idea of a standard deduction is that's an amount you get to deduct with no paperwork at all. You just put it on your return. Okay. Let me see if I can explain this. There's a line at the bottom of the first page of your tax return called adjusted gross income. And that flows to the second page. There's a bunch of deductions that go before that adjusted gross income number is calculated. And in my world, the terminology for those is above the line deductions because they fall on the first page of the return and they fall above that adjusted gross income line. Okay? There's been some changes to those. I don't imagine there's too many of the folks whose faces I'm seeing in this room who have moved for job-related purposes recently, but you may very well have working children who did. They're not going to be able to deduct those moving expenses anymore, so you better hope their employer pays for them because they're not going to get to deduct them. On the other hand, if the employer does pay for it, it's going to be included in their taxable income, so you're losing no matter what. All the people to whom that does not apply is active duty military. So again, it's going to be a lot of tracking we're not going to have to do, but the effect on the income tax return may not be desirable. There used to be this screwy deduction for tuition and fees, which the rule was you can figure out what the deduction is, you can figure out what the credits are, you can use whichever one gives you the better tax benefit. Bottom line, almost everybody wound up using the credits. There was almost no condition under which the deduction gave you a better tax benefit, so they have eliminated the deduction side of that calculation, which will make things much easier to deal with. There's this weird thing called domestic production activities deduction. That related to an adjustment to income for people who were involved in certain types of businesses that produce things for this country. And so that would be people like your window manufacturers, your auto manufacturers, architects and engineers who support those things, that kind of stuff. We got rid of that and exchanged it for something I'll refer to a little bit later, which is a deduction for a portion of the income you're going to get from a pass-through business if you happen to own one. So that thing went away. It was not very useful anyway. If you know people who are in the middle of getting divorced, but they haven't got their agreements in place yet, this is one to look out for. Always in the past, payments that were properly classified as alimony were deductible by the person who was paying them, reportable as income by the person who was receiving them. Starting with anything that happens in 2019 or later, so we get 1 year grace on this one, but starting in 2019 or later, new divorce agreements, any that are substantially modified, that will not be true. The alimony will not be deductible, nor will it be reportable as income by the recipient. It falls in exactly the same rules as child support. The one thing we haven't heard yet is that up until now, it was considered earned income for the purposes of determining whether or not the recipient could fund a Roth IRA. We haven't heard. But the tax law itself, the section wasn't changed, and it reads taxable alimony. So I have a feeling that's going to go away, but we haven't seen regulation on that one yet. But that will apply not only to new divorce agreements, but also to any that are substantially changed. It's likely to become a negotiating point in these agreements as people start to look at what's their real after-tax income and real after-tax cost of these payments. And the chances are that the higher income person is going to be arguing for a reduced payment to try to mitigate their after-tax cost, whereas the person receiving it is going to want a higher payment because it's going to give them more money in their pocket. So it will keep the lawyers busy. The tax accountants will have something hopefully to say if they think to ask us ahead of time, but they don't usually. In fact, we usually don't even know the divorce happened until the tax return shows up to be done. All right, this one rattled around for a bit. If you did a Roth conversion during 2017 and you are considering the possibility of recharacterizing, unconverting some of that, you can still do it up until October the 15th of 2018. If you do a Roth conversion in 2018 or later, you will no longer have that recharacterization option. You just can't. So it's a final decision. Okay? The only little side bit on that is if you made a deposit, not a conversion, but an actual deposit into one type of IRA, and it turns out when you get your taxes done, oops, you weren't eligible to do that, we need to change that, or, oh, you can get a better deal if you change it to the other thing. Contributions can be recharacterized. It's only the conversions that can't. Congress thought we were abusing that by doing a conversion, letting it sit over there for the whole year, then realizing, hey, the value had gone down, so unconvert it, put it back in the traditional IRA, not pay any taxes on it, and then turn around and redo it and be able to convert more shares at a lower, tax cost. They decided that was an abuse, so they put that part out. However, there were other reasons for doing it, and the other reasons aren't going to work anymore either.
So that's excuse me, that's the current. So if somebody converts in January 2019, they can't recharacterize by the end of 2019?
That is correct. There will be no more recharacterizations after
at all.
Any conversions that were 2017 conversions. Anything after that, no, not at all. I don't know if everybody heard that. Sean was just trying to clarify the cutoff dates on that. You do have until the extended due date of your tax return to do a recharacterization. And I know a lot of people think that means you actually have to extend the return. It's not so. You have until the extended due date of the tax return, regardless of whether or not an extension was filed. The only trick is the extension only extends the time to file. It does not extend the time to pay. So unless you're absolutely certain you're doing that recharacterization, you're going to have to pay the taxes in April anyway. At that point, you might just as well file a return and plan on amending if you decide to recharacterize, because it's going to essentially come out to the same thing with a whole lot less worry along the way. High income taxpayers, you used to lose a little bit of your itemized deductions kind of across the board in a phase-out sort of way if you made more than a certain amount of money. The phase-outs are gone. Whatever your itemized deductions are or your standard deduction is, that's what you're going to get. That's going to help some people. And it really helps people who had significant charitable contributions where they were losing some of the effect of those because of the phase-outs. The other thing you're going to like is that those of you who were subject to alternative minimum tax for one reason or another, the threshold has been raised, the exemptions have been raised. Many of the things that used to trigger it, like high income tax deductions, large numbers of children, high itemized or miscellaneous itemized deductions, those things all went away. So now we have fewer triggers and higher thresholds. The chances are there'll be a lot less people who are going to get caught by the alternative minimum tax. And that, if those of you who've ever paid it may recall, is that nasty thing where you figure out what your tax return, what your taxes are, and then you have to go do this extra calculation, and $3,000 or $4,000 extra gets tacked on to make it fair. That's not going to hit as many people anymore. Now, this is the one I was talking about earlier. When they changed this method of computing inflation, they went to something called a chain CPI, slows down growth of inflation-adjusted numbers. What if we got in the tax code that are inflation-adjusted numbers, tax brackets? Some of the maximums on things like gifting or IRA contributions, a few other things. Any place in here that you see a number that is potentially an inflation-adjusted number, you may see a different number in a month or so after Congress decides to go back and recalculate all this. We're sort of hoping they'll decide they're too busy and they don't do it. But they have said, IRS has said, they are going to recompute anything that they had not issued before this change was made. So some of these numbers may not be as solid as we thought they were going to be. That's really going to be a pain with the gift and estate tax exemptions. Okay, education benefits. 529 accounts. Starting next year, you will be able to take a distribution of up to $10,000 per beneficiary, and that's not per account, that's per beneficiary, for qualified expenses for primary, secondary, or religious schools, public or private. This may be an incentive in some cases for people to dump their old Coverdell savings accounts, which weren't that wonderful anyways because they had such income limitations on them, but they were the only accounts that allowed you to take money out for primary and secondary. Now that that's been moved into 529, I expect that anybody with an old Coverdell is probably going to want to look at rolling it. We don't know what Arizona's going to do with that. We don't know what Arizona's going to do with any of this stuff. But that could be a problem because the contributions are permissible up to $4,000, I think it is, for a married couple as a subtraction from Arizona income. But if Arizona doesn't allow this kind of distribution, then either it's going to get added back into income or something's going to happen to the 4,000 or who knows. We honestly don't know how they're going to deal with this. But the other thing, this was kind of funny. There was an attempt to change the rules on the 529 so that you could start the account before the child was born. Right now, the child has to be what they call a life in being, which means it has to actually have been born and be alive at least at the time of the contribution. They did not change that rule. But the one thing that people forget about is that you can set up a 529 with anybody as a beneficiary, including yourself, and then later on change that beneficiary. So if there's an unborn child out there and you want to start saving for them early, do something like that. Set one up under your own name for yourself, and then after it's been born, go ahead and roll the thing over into an account with a new beneficiary. Nothing wrong with that, not at all. Just isn't mentioned anywhere in the tax code, other than they do say you can change beneficiaries. There's no change to, yes, Steve?
I was late to this one, but going back to the inflation.
Okay.
Somebody wanted to know if HSA accounts are inflation adjusted, the amounts.
HSA inflation accounts, inflation adjusted. I think they are, but at such a slow rate that this may not affect them. And there were no changes on the limits for this year that I know of, but I could be wrong. That's one where I'll have to check because I honestly don't know.
Okay.
Okay, there's been no changes on most of the other education stuff. There's no changes in the rules on the American Opportunity Credits, lifetime learning credits, no changes to student loan interest deductions. One nice one that they finally came to the common sense, if you're unfortunate enough to to have a son or a daughter who passes away at an early age and they still have outstanding student loans and those loans are canceled. Up until this change, those used to be counted as income. That's no longer true. A student loan that is canceled as a result of a death or a severe disability will no longer be considered income. And that makes some sense. And there's been no change to the exemptions from income on the savings bond interest if it qualifies. All right, now we get to some stuff where things did change in fairly significant numbers. The child tax credit for children under the age of 17, it's been doubled. It's gone from 1,000 to 2,000 per kid. I'm sorry. Yeah, 2,000 max. It used to be a 1,000 max that was fully refundable. Now it's 2,000 max and 1,400 of it is refundable. The refundable part of it was calculated based on a computation that was based on adjusted gross income, as was the credit, and they've greatly increased the amount of adjusted gross income for that phase out. So a lot more families are going to be able to take these child tax credits than they could before. In addition to that, they've tossed in an additional $500 per dependent credit for somebody who is still your dependent, but is no longer considered a child. They're 17 or older, but it may be a dependent parent, for example, who's living with you. There will be a new credit tossed in for those. So they have to be dependent, so we may still be having that conversation, but at least it's something that we get for taking them into our homes. They have to have a valid Social Security number. It can't be a temporary. So children that are not yet completed their adoption, either within the United States or from outside the country, and have temporary tax ID numbers, will not count for these credits. But they do count for the $500 credits. They've changed the tax brackets for estates and taxable trusts, and I didn't have them on those other charts because there just wasn't room. They're a little less complicated than they were. They're a little bit higher. But here's the really fun part. The so-called kiddie tax, the ones that hit the kids who have investment accounts that have more than a certain amount of investment earnings in them, and they don't have major jobs yet, maybe they only make $3 or $4 grand a year, they were being taxed on their investment income above a certain amount at their parents' tax rates. This has now been changed so that they will be taxed at the rates that apply to estates and trusts, which is going to lower it for some of them quite remarkably. It also means we'll be able to complete the kids' tax returns and get whatever refunds they're entitled to long before we can even finish the parents' returns, because the parents' returns will no longer be a factor in the computation. So that's going to make life a little easier for some people. It's going to encourage people who have been building investment accounts for their kids to do so. Previously, it was kind of like, well, why should I bother, because they're going to pay tax on it at my rate anyway. Well, now there is going to be some tax advantage to putting them in accounts for the kids. The lifetime exclusion for gifts and estate tax, it has doubled. That's a number I'm sure of. The question is doubled to what? Because the original number for 2017, or 2018 rather, was supposed to be 5.6 million individual and 11.2 for couples. But that's an inflation-adjusted number, so we don't know whether it's really that much or some number slightly less than that. Whatever it turns out to be, it's going to be doubled. Okay? That really means that an awful lot of people will no longer have to worry about taxable estates at all. That may mean in some cases, and there's lots of other cases why it's a good idea to split up a trust after the death of the first spouse, but for some people who only had the wording in there just to be able to take account of these estate tax limitations, really good idea to have your trusts reviewed, because some of the old language would result in all of the money going into the credit shelter trust because it says funded up to the exclusion limit. Well, if I raise the exclusion limit, that puts more money in the credit shelter trust, which puts it where the surviving spouse cannot as easily get access to it. So sometimes there's a good reason to go back and look at those old documents, make sure they're still doing what you really want them to do with this taken into account, and maybe do some revisions along the way. There's been no changes except for what was already scheduled. For 2018, it's supposed to go up to, the gifting limit is supposed to go up to $15,000 per recipient per donor. However, once again, this is an inflation adjusted number. And the rule on this one was that it went up in $1,000 increments. So you had to get over $500 on the inflation adjustment on 14,000 before you could get to the 15,000 number. It wasn't an automatic bump. We don't know. Maybe it'll stick, maybe it'll go down a bit. I wouldn't make too many maximum gifts right at this moment if I were you. Do your 14 grand and wait a little. Okay, this is where this gets really squirrely. Remember I was talking about the line deductions before. Now we're going to move to something called a below the line deduction. Not only is it below the line, which remember I said was the bottom line on the first page of the tax return, this will actually go on the tax return after the standard or itemized deductions has been subtracted. So it becomes like another deduction that is separate from those. If you own a small business, sole proprietorship, partnership, S corporation, in which you're getting pass-through income, portion of the profits, in addition to whatever's paid to you for working there. For most of these businesses, there's going to be a deduction you'll be able to take on your personal return for 20% of that pass-through income, which will lower the amount of tax that you're going to pay on it. This is an attempt to level the playing field, because corporate, like C corporation taxes just dropped to a flat 21%. It's a huge drop. But that meant that there would be cases where individuals owning these smaller businesses could effectively be paying more than that on exactly the same type of business, just based on how it was owned. So by putting the 20% in, it's an attempt to kind of level that out. There will be some things that will not qualify. Whether or not they qualify in part can depend on how much your other income is. This is a very, very complicated calculation. You're going to need help. But if you qualify for it, it will potentially take a fair bit off your taxable income. The main thing to notice here, it says it does not apply to service businesses where the principal asset is the reputation or skill of one or more employees or owners, or involves the performance of investment services. That definition brings in people like me, people like Ironwood, people like your doctor, your lawyer. They all fall under this category of things it doesn't apply to. Okay? But if the rest of the income's low enough, it's okay, because that restriction doesn't count. And it's also okay if, even though it's a highly skilled professional business, if there's multiple people working in it and they use employees to perform the services, it may still be okay, even though it's on it, because the principal asset in that case is not the expertise of one person. Okay? That's why I said this gets complicated in a hurry. The one company type that is excluded are the engineers and the architects. They get a pass, they're allowed, and even though they fit that category, and they are basically the same people who got a pass on that domestic production activities deduction. They got it no matter what. So it's kind of a trade-off, but unless you happen to own a small business, it probably is not going to apply to you anyway. Couple other things for businesses. They're going to have higher limits to expense personal property assets, up to, I forget what the number is, but it's a big number. And we'll be able to use that on residential property rentals as well. We didn't used to be able to. It used to be that okay, that was fine. I could go and buy a piece of laundry equipment, stick it in my laundromat, and write it off 100%. But if I went and bought it and stuck it in my residential rental, I had to depreciate it over 7 years. Well, that's not true anymore. I can expense it in the residential rental property as well. Whether or not residential rental property is going to qualify for that 20% deduction is an open question at this point. And the reason it's open is because to qualify for the 20%, it has to be classified as a trade or business activity. We have argued for a long, long time that individual rentals, generally speaking, do not rise to the level of a trade or business activity because we didn't want to pay self-employment tax on the net profit. That was the bottom line. But without them being that, they're not going to qualify for the 20% deduction. So expect some more go around on this. At this point, we're looking to the possibility the IRS may issue a regulation that says they do qualify regardless, as long as they otherwise qualify to be deductible losses. But we don't know for sure. Okay, this is a killer. I don't know about you guys in this room. I imagine there may be some folks on the web. Don't raise your hands, but just think. How many of you at some point in the past have gone out and bought a vehicle that you used for exclusively or almost exclusively business purposes, and 3 years later when you were done with that vehicle, you traded it in on the next one, and you didn't have to pay any taxes on that, even though you may have written off the full value of that vehicle 3 years before? I see at least one person in this room nodding. Okay, that's not going to work anymore. 1031 tax-deferred exchanges will be limited to residential rental, or to real property, pardon me, not residential, to real property. So rentals of all kinds, business and residential, that'll be fine for the building and the land on which it sits, because that's all real property. You'll still be able to exchange your rental property for a piece of vacant land or the other way around. That's all real property. But you're not going to be able to trade in your 2013 truck on a 2018 truck and not expect to pay some taxes on the process if you wrote off the 2013 truck in the first place. Because whatever you get as a trade-in allowance is going to be taxable. Used to be we didn't have to do that. That's also not very nice for people who have businesses that have heavy-duty business equipment and stuff, where they used to do the same thing. They are also going to have to recognize some gain on those trade-in values, which is unfortunate, but is part of the trade-off for lowering the business taxes. If you're in the middle of an exchange, you started it in 2017, you haven't finished it till the beginning of 18, that's okay. That'll still come in under 2017 rules because it's a 2017 transaction. And real important to understand, there is no impact of this on exchanges of life insurance policies or annuities. Those come under a different tax code. They're in section 1035. They're still fine. This only affects the 1031 exchanges. Okay, so now let's talk about how we can get around some of this junk. Get around it legally. Because you know what the old joke is between tax evasion and tax avoidance, and the answer is about 20 years. This is all legal avoidance if you can make it work in your numbers. Let's suppose that you're a person who, when you look at all of your itemized deductions for the year, you're getting pretty close to one of these standard deduction numbers, but you're not quite there yet. And that's going to be the case in both years. If you have an expense or a charitable deduction where you can choose which year you're going to do that. Let's say, for example, you're sitting at the end of 2018, something went wrong and you're now faced with needing some expensive dental work. If I can expense all of that in one of those 2 years and none of it in the other year, maybe I can bunch my deductions in a way that will get me over the standard threshold 1 year and under it the next, and be able to take advantage of both types of deductions. It's going to take a little bit of planning, You have to stop at the end of the year and see where you are and what options you have. But this may be some situations where the deduction bunching might become useful. It's always been true. It's just that these higher numbers, it can be a little bit more worthwhile to do that. Also, if you mentioned HSAs earlier, anybody who's still working and is eligible for one of those things, you've got a high deductible policy through your work. If you're not using an HSA now, please people, start using them. They're the best deal around when it comes to medical expenses because you get a before tax deduction for your contributions. When the money comes out to pay medical expenses, it's not taxable. And if there's any money left in there at the end of the year, that's fine, it's yours, you can roll it, it just follows on to the next year. When you get to be 65, you can't add to it anymore, but you can keep on using it for as long as it takes to use it up. And once you hit 65, you want to just take it out, you can, but it'll be taxable income. Okay, but as long as it's medical expenses, it's not. So everybody who's eligible should be using an HSA. Okay. Be very careful with your withholding, especially state income taxes. Don't let yourself get into the trap of having way too much withheld and getting a big fat refund at the end of the year, because you're not going to be able to, may not be able to deduct all that stuff that was withheld anymore. You may get part of it, and you're not going to get all of it. Now the flip side of that is you're also not going to pay taxes on all of the refund when it comes back, because there's this thing called a tax benefit rule that says that if I receive income that's related to something I previously deducted, it's only taxable to the extent that it reduced my taxes by taking the deduction the previous year. But a lot of people tend to get lulled into this, and I don't think it's wise to see large state tax refunds anymore. I'd rather you owe a little bit, maybe pay a tiny little bit of a penalty, than lose out on being able to deduct some property taxes because you got, in the end, over the 10,000 limit. It's just not smart. And this is where we can get some hassles around here. I don't want to go into the history of Arizona with its tax conformity legislation, but let me explain how it kind of works. Every year, the Arizona legislature has to pass a bill that they call a tax conformity bill, in which they state which provisions of the federal income tax and any things that have changed during the year they're going to adopt for the year. Typically, they start talking about this around about November, sometimes December. If we're lucky, we get it very early in the year. I remember one year, not that long ago, all too clearly, where we didn't get the information on how much they were going to conform to, I think it was 2013, until after April the 15th of 2014, when we'd already filed a lot of 2013 returns, and we had to go back and amend some. And for those where we thought it might be a problem early enough on, we had stacks of them sitting on extension waiting for the Department of Revenue. Most years it's not a big deal. It's just that they don't get to it. Or somebody tries to tack some kind of totally irrelevant amendment onto the bill, and then the governor can't sign it, and it has to go back and on and on. I got a chance a couple weeks ago to ask State Senator Kate Brophy-McGee if she'd heard any rumors about what they were going to do about conformity for this 2018 tax law. And I said to her that I was fervently hoping that they would start discussing it early in the year while they had time to study it instead of waiting until next November or December. And she said that actually she was pretty appalled at the history of tax conformity legislation in Arizona. She had not heard any rumors. She was not holding her breath. And I do know that the Arizona Society of CPAs and their tax liaison committee is actively pounding already on the Department of Revenue to push the state legislators to do it. It's not the Department of Revenue that has to do it. It's the legislature, but they depend upon input from the Department of Revenue. So our best approach is to pound on the Department of Revenue, and maybe they'll get it done. Bottom line of all of this is I can't stand here to tell you how this is going to affect your Arizona tax returns. I can tell you this much, if they don't do anything, you can expect your Arizona taxes will probably go up, especially for small businesses. Yes, Kathy?
Tax credits for situations like working poor and education, schools, all that. Any rumors out there?
There's no rumors, and that's my big thing, is think in terms of maximizing your use of those Arizona credits. The public school credit, the private school tuition, what they used to call the working poor, which is now called qualified charitable organization, and the qualified foster care agencies. Each one has their own limits. You can use all four. They're not mutually exclusive. The more money that you push into that, it comes directly off your Arizona tax bill, and it shifts those dollars from taxes paid to contributions paid on the federal schedule, takes you out of a limited area into an unlimited area, or generally unlimited. There's no rumor that any of that's going to change. So I would say, yes, use those credits. Remember, you can still make those contributions up until April 15th of this year and have them apply to 2017 tax returns. Word of caution on that, it is not the filing date. It is April the 15th. That is hard-coded in the Arizona law. There is no provision for it to change if the filing date moves. So it happens to be a Sunday this year. Don't get caught on that. Make sure they've got your money by the 13th. The other thing you want to look out for, and I happened to notice this on a return that I was looking at just the other day that had been prepared by somebody else for last year. With you know, if you ever look at your investment accounts and any of the ETFs or mutual funds that are based globally are probably got some foreign taxes withheld on some of the dividends and stuff. We have options in the tax return. We can either take a credit for those or we can take a deduction for them. Well, if I'm going to start limiting the amount of tax you can deduct, guess where I want you to put those foreign taxes? I want you taking credits for them, not deductions. You may find, if there's enough of it, that you might have to fill out an extra form, which is kind of a pain in the neck, but it's not that hard to do. And the value of this is, once again, they come dollar for dollar off the bottom line of your federal tax return. They're not reducing it just by a percentage. So there's a lot more value in credits than there are in deductions. And nobody really realizes this, but there is an Arizona form for the same purpose. And it looks like double dipping, and it probably really is, but it's allowed in the Arizona law, and almost nobody ever files it. But if I'm seeing ones where there's multiple hundreds of dollars, I'm going to look. I'm not going to go mess with that form for $10. It's not worth it. I'm not even required to file the federal form. If I'm under $600, I just take the credit. But if I have to go file the federal form, I'm going to start looking at those Arizona forms as well. We might as well get them back if we can. Okay. Now for the planning, for those of you who have the misfortune to be in a business where you have significant amounts of unreimbursed legitimate business expenses. I see these on higher level managers who are expected to do a certain amount of driving around or entertaining with clients or whatever on their own dime, and they don't get paid back for it. I see it in situations where maybe we've got an S corporation that is a law firm, and there is a significant difference in the profiles of the clients for one lawyer in the firm versus the other. So the firm says, okay, we will pay for certain expenses that you incur that benefit the firm generally. But if they only benefit your relationship with your clients, then you're on the hook for paying them. We used to lump all that stuff in these unreimbursed employee business expenses. Now we can't deduct them. So if you happen to be in a position where that's going to apply to you, my message to you is see if you can reconstruct or restructure your compensation package. Maybe accept a little bit lower salary in exchange for an allowance for these kinds of expenses. So the company's not out any money, it's just putting the monkey somebody else's back, okay? The trick is you don't want to go for a flat allowance because that's going to be taxable with no offset of the deduction. So you need an accountable plan when you turn in the receipts and the company pays you. But the company's not going to necessarily want to come out of pocket extra money just to benefit you on your tax return. But if you're willing to say, okay, I'll take $2,000 less in salary, you give me a $2,000 accountable expense account, and I'll submit the receipts and you pay me up to the $2,000. It's not going to hurt them. In fact, it's going to save them some money because they're not going to have to pay their share of the FICA and the Medicare taxes on that. So some companies will be open to that kind of restructuring. Some other people may be legitimately, and I use that word advisedly because there's a lot of abuse in this area, but some people may legitimately be able to restructure things such that they can become independent contractors with respect to their former employers. And they can go and create their own business entity and contract between it and their employer to provide services. If you can do that and do it legitimately, you can maybe get yourself into that position of the 20% deduction for your net profits. But you have to be very careful because you have to make sure you're paying yourself a reasonable salary. Don't get tempted to cut your salary back just to save on the Social Security and Medicare because the IRS will get you if you do that too hard. But there's at least some openings there where you might be able to change things so that these non-deductible expenses go somewhere else. Yes?
What if you're a 1099?
If you're on 1099, all the expenses that you normally would deduct on your Schedule C are still there. Okay, with one exception, they have put some new limits on meals and entertainment. Entertainment's gone. Meals are still allowed at 50% deduction. Be careful what you do in terms of where you take your clients. You don't want it to accidentally turn out to be entertainment when it was really a meal. But those deductions are still there. Okay? And that's why I said, if you can legitimately become independent and either form your own business entity or go to 1099, you can help yourself with some of that stuff. But you do have to make sure that you're not just getting reclassified as an independent when you're really still an employee.
Did I mention?
Okay, now I know I got a few people in here that this one's going to apply to. The rest of you go to sleep for a bit. Charitable contributions. Let's suppose that you're fairly close to that 24,000 limit, but maybe you're just barely over it, but a chunk of it is in charitable contributions. And let's say, for the sake of the discussion, that you have a required minimum distribution amount on your traditional IRA of $30,000. Normally, you may take your $30,000 distribution minus taxes and stuff, and you may give $3,000 of that to your church. That would be what you would normally do. If you're over 70 and a half and you're into this mess, there's a thing called a qualified charitable distribution. I can call up Scene and say, hey, send me the form. I can direct Charles Schwab to directly send the $3,000 from my traditional IRA to my church and reduce my minimum distribution by that same $3,000. Okay, it has to go directly from the IRA to the charity. It can't come through me. Why would I want to do that? Because now I've changed a charitable contribution, which is an itemized deduction item, to an above-the-line reduction in income. I just took $3,000 off my reportable income before I got anywhere near itemized deductions. So now maybe I'm in a position where I can make full use of the $24,000 standard deduction and reduce my income by $3,000. And that may be enough to keep me below the threshold for some other bit of ugliness, like the Medicare premium adjustments or something like that.
Does the whole thing have to go one at a time, or multiples through Charles Schwab or whatever?
Well, no, you can kind of do it however you want. You don't want to kind of bury Schwab in paperwork.
Yeah.
But
the 3,000 is the.
there's no maximum. I just use that to make nice round numbers.
Okay.
But no, in fact, I had Colleen call Charles Schwab to ask if they had a minimum. because it's paperwork for them, I thought, well, they might say we won't do it for less than, $200 or whatever. And she called me back and she said, no, they said they've seen it done for as low as $5. Which I think, that's a little extreme. I figured you probably want to be into at least a couple of hundred before you mess with this. But the one thing to be very wary of is you can't use that for a contribution that would qualify for one of those Arizona tax credits. Because the Arizona law says it must come directly from an individual. Okay. And of course, also, this only applies if you're over 70 and a half. So if you're under that, unless you're getting close to that, don't worry about this for a while. But I know there's a bunch of us in here who can take advantage of this if we plan ahead on it a little bit. And with the, where are we? That's how to do it. Oh, this one. With this little gotcha hiding in here, being able to reduce your above the line income becomes more valuable if you're at one of these thresholds too. You know that Medicare now, the premiums aren't a one size fits all kind of thing. Under, 170,000, I think it is, of income for a married couple, you're still going to pay the base Medicare premium, which in Part B this year is $135. But if your adjusted income is over that 170, you're going to see a little bit extra tacked on your Medicare premium. And then there's another level at which a little bit more gets tacked on. And pretty soon you're up to where you're paying twice what you would have ordinarily been paying in Medicare premiums. Now, fortunately, that only applies for 1 year, and then it'll go back down if the income goes back down. But still, it's a nuisance. And if you can get out of that problem by using the qualified charitable distributions, and some people will be close enough to that threshold that might be a reasonable thing for them to do. If you can do that, then it's worthwhile because it'll save you that incremental Medicare premium. Why not? So there's a lot of little opportunities here, and most of these were there before. It's just that the numbers have gotten bigger, and now there may be a little bit more worth discussing. So that's just a little bit more about what we talked about before. Be aware that your 2019 premiums will be computed in the fall based on your 2017 returns, and so on. So as we step through, I think it's starting with 2019's returns where the impact kicks in, but there is in the law, and it was I think it was the 2015 tax changes they did this, the brackets at which these incremental Medicare numbers start to happen got compressed a little bit. So those will actually start going up more quickly. But I haven't seen any good solid numbers on that yet because Social Security hasn't updated the brochure on the website. They're still talking about 2017 premiums, so I don't know. Oh yeah, how to do it, never mind. We went through all this. Oh yeah. One thing you do need to know is that if you have something that would reduce your adjusted gross income in the following year, like let's say you retired in a year, or you had something else happen that's going to change your income in the downward direction for the following year, you can actually go and appeal those Medicare adjustments. But they have to be what they call life-changing events, and they will not take into consideration things like abnormally large capital gains or Roth conversions or any of that stuff. It's just, well, that's too bad. You made too much money that year. You're going to pay a higher premium. But certain life-changing events you can do. You can also do it if you amended your return after the initial filing, and the amended return is below the threshold. They're looking at the initial filing. So if you can go back and show them that you amended the return and you're now below it, you can appeal it. Okay. As you know, Roth distributions are not taxable income, so they're not calculated in these thresholds. And that's an even better reason to get all those conversions out of the way. And you notice the slide says do it before age 63. Why 63? Because when you turn 65 and they're computing your premium, they're going to be looking at the tax return from 2 years prior, which was when you were 63. So if you can get your Roth conversions out of the way before then you don't have to worry about their impact on this. If you're still doing it, then we have to plan a little harder, know where we're going, especially now that we can't recharacterize stuff. Okay, a few little other odds and ends that people tend to miss. If you're self-employed, all of the medical insurance premiums for yourself, your spouse, your dependents, and your adult children under the age of 27 can be added up and taken as an above-the-line deduction for your medical insurance. They don't have to go on Schedule A. That also applies to partners and partnerships, things taxed as partnerships, and people who own more than 2% of an S corp, provided the W-2 is correct. That is something that I do see people miss, especially on self-prepared returns. They just automatically think, oh, medical insurance premiums have to go over on Schedule A. Not necessarily. I mean, if you do put them over there, you're going to lose part of the value of them if you can bring them forward to the front of this return. And by the way, people who are already on Medicare, but who still own their own businesses, can have the business reimburse them for the Medicare premiums. It becomes part of the health insurance that's paid by the business and fits into this category. Okay, so that's something to make sure to do if you're in the right position. Well, let's not talk about this. This is so good. I'm skipping over the Medicare surtax business because it's just complicated, and there's a lot of things that are included and a lot that aren't. And I think I will just commend those particular slides to your own reading. Okay, I alluded to this earlier, and I actually had Colleen make a correction to an email she sent out earlier today. Don't forget when you're doing your 2017 returns that we're back to 7.5% of income as the threshold for deducting medical expenses. It was supposed to be 10%. It went back. This is good. It's going to be back there next year too. Arizona doesn't have that threshold, so they let you deduct everything. The so-called individual mandate from the Obamacare stuff, that's gone starting next year. There was some effort to get rid of it for this year. It's still there, but beginning, it's eliminated beginning in 2019, I'm sorry. So it will still apply to both 17 and 18. And unlike last year where the IRS said, we're not sure whether this is going to go away, so if you don't want to put it on your tax return, that's okay, we'll process your return anyway. They've said no. Now that we know it's here until 2019, you must put it on the tax return if it applies to you, otherwise they will not process the return. But as long as you're working or if you're on Medicare, either one, you have normally going to have coverage anyway. It's the self-employed who may not, mostly, or people who have been out of work for a long period of time and weren't able to carry COBRA over and simply couldn't afford the premiums. And then, as I mentioned, we have no idea what Arizona's up to. What we're kind of hoping they will do, just kind of hoping, is give us a place somewhere on the Arizona return to do a similar subtraction for the business income and adjust their standard deduction thresholds so that they kind of sync up with the feds. And if they're not going to allow us all those little things or big things that the IRS took away, then we're sort of hoping they really will increase the standard deductions, because that's where people are going to get hurt. That's where the folks with the large investment fees and maybe the casualty loss for like the stolen car or whatever, some of those things are going to wind up paying a lot more in taxes than they did before. So all we can do is hope. Arizona is just a huge black box. And I'll let you know if I find out anything. Okay, this is just, briefly, just a couple things to look out for with these Arizona credits. I see publicity from time to time from especially the private school organizations where they'll send a letter to the parents and they'll say, we're trying to raise money for these scholarship funds, so please, make sure that you make your contribution. And if you want to recommend a child for the scholarship, here's a place on the form to write in the child's name. Parents need to be aware that by law, the tuition organization cannot be bound by those recommendations. All they can do is take them into account. Kids have to apply and qualify just like any other student. Also, if the school catches you engaging in what they call credit swapping, where one family will make a donation and recommend another family's child, and that other family will make a donation and recommend the first family's child, that's called credit swapping. They're not supposed to even accept the contributions under that kind of situation. There's not been too much auditing going on of that, but I wouldn't be surprised to see Arizona start tightening up on things like that, because there is some abuse out there. It's unfortunate, but there really is. Don't forget that the qualified charitable organizations and the qualified foster care were separated. 2 separate lists now. They both have their own limits. So you can do, on a married couple, $800 to a qualified charity and $1,000 to a qualified foster care agency. It used to be the 2 were combined and had 1 limit. So now that's been split out. That was split out last year. I've put a link in here to a page on the Arizona Department of Revenue's website's tax credit page. There are links all over that page to the various credits that exist. And about the middle of the page, you will find links to the schools and the tuition organizations and the charities that qualify for these things. Double check and make sure they're on your list, because some of them drop off from year to year. They lose their qualifications for one reason or another. Some as simple as they simply forgot to file the paperwork. But if they're not on the list, they're simply not allowed for that year. And don't forget, like I said, these are 4 separate independent credits. If you have enough tax liability, you can use all 4. If you overshoot, have more credits than you have Arizona tax, it will roll forward up to 5 years. Yes?
Is military family?
Military family, I think, is still there, but you have to look, and that's one where it's actually run by the Department of Veterans Affairs, so the link is on their website, not on the Arizona. And that one is one you want to, if you're going to do military family credit, and if it still exists, get in early, because they have $1 million, I think it is, cap each year, and usually they're maxed out by early November. So if you want to check into that one, I'd check in now. And I think that's about where I'm going to stop. Any more questions? Yes, Kathy?
Margaret, we have kids from 6 to 17, 18. They're in different schools. They move from one school to the other. We just keep donating. We never file the proper paperwork. However, we always claim it. And what's the proper paperwork for schools anyway? But
Well,
we just keep
Yeah, I know what you're saying. Most of the schools, if they're set up to accept these, they usually have
public
a
schools.
link on their website, if they have a website, where you can go in and you can make the contribution and they'll send you some kind of acknowledgement for it, okay? Like any other charitable contribution, if it's more than $250, you're supposed to have a written receipt, okay? When you go to get your taxes done, if your tax preparer is paying attention, they will notice that there are multiple schools, and they'll just go add up however many of them they need to get to the $400 and stop there. And the rest is just charitable contributions. And do the same for the other types of credits. I can't tell you how many times I've had people turn in their tax returns, say nothing to me at all about working poor credits. And I go in and I find there's $100 to St. Mary's Food Bank, and there's another 100 to someplace else. And by the time I'm done, I've added up $400 worth of Arizona tax credits, and they don't know where I got them from.
Right.
And it's just looking at the list and paying attention to the names. Not all tax preparers will do that, and certainly TurboTax and whatnot won't do it unless you tell them.
So we just lucked out because for some reason, we don't go there, we'll write a check and give it to the family and have to give it to the school.
Now, the other thing is the donations have to be made directly to the school.
And they're written to the
Okay, so
school.
as long as it's paid to the school, not to the PTO,
Right.
They can be made either to the district or to the school
Without
itself.
going through the forms. and
Right,
all
there
of
don't
that.
necessarily have to be specific forms, but we have to be able to document to the,
We could back it up.
yeah, you have to be able to document it to the satisfaction of the Department of Revenue, but no, there's no specific form.
Okay.
Anybody else?
And even with foster kids, it has to be in a certain category.
Right.
You can't just give to any foster.
Right, the foster care agencies especially are the ones where you really need to check and make sure they are on the qualified list.
Yeah.
Because you can't necessarily tell just from their name whether they qualify or not. I'll give you a prime example of that. There's one called Rosie's House. Now, just based on that name alone, wouldn't necessarily dawn on you that they deal with foster kids, but they do. You know, and so it really pays to check those lists and make sure before you make a donation that you know what category it's in. Yes.
In regard to this, if you want to make contributions, say to a Mesa Public School, or maybe it's similar for other school districts, you can go in online, choose your school, and get an immediate.
Yeah, and I should do that, but just because we have so many grandkids, so many kids that are all over the place, we can write.
Yeah, I know what you mean. Sometimes it's easier to write the check than it is.
Margaret finds it.
Hope Margaret's awake that day, yes.
Margaret.
But you know, you get some surprises, you find things you didn't know before. Came to my attention that where I live now, we have a program that mentors high school kids that are in an alternative high school program. There's a school in the Phoenix Union District, no, is it Phoenix Union? No, it's one of the further west ones. But one of the school districts anyway, and the high school is Desiderata High School, and they have a mentorship program. And so I'm gonna start leaning on my neighbors to make their school contributions to that organization. Because what better school to give it to than the one that's already sending us kids for their mentorship program? You know, let's sponsor a few more kids for the mentorship programs. And so there's all kinds of stuff like that that shows up. It has to be for an extracurricular activity. So. Anybody else? We're starting with the loose folks here. 7:30, I think maybe it might be about time to wrap this up. Well, thank you all for coming. Thank you to everybody who's come today.